Okay, this is a little bit of a long one, but I think it's a good wrap-up of a lot of things that we talked about in this chapter. Okay, so on March 17th, accounts receivable of $2,500 were written off as uncollectible. Well, remember, when you do that, you write off accounts receivable and uncollectible. So we're debit allowance for doubtful accounts for $2,500, and we'll credit accounts receivable for $2,500. And then on the 30th, we loaned an officer $40,000 and received a note. So we're going to debit notes receivable for $40,000, and we're going to credit cash for $40,000. Now on May 30th, that's 2 months later, we discounted the note at a local bank, and the bank's discount rate is 12%. So the note was discounted without recourse, which means that the bank owns it. If they don't collect it, sucks to be them. And the criterion for sale are met. So we have to figure out how much this works out to altogether. So let's get to it. Remember, the basic rule, whatever you got is worth whatever you gave up to get it. So first we have to figure out what we gave up to get it. So we gave up a note, had a face value of $40,000, and the interest to maturity, because we're giving up all of that, is 9% of $40,000. That's $3,600. So the asset that we're sacrificing is worth $43,600. Now the bank's discount rate, their discount rate, they tell us, is 12%. So we have to figure out what they're going to charge us on that. So we have $43.60. That's the amount at maturity. The bank's rate is 12%. It doesn't matter what our rate is. We're dealing with the bank. And they only have this for 10 months left, because we did this originally the end of March, and now it's the end of May. So they only have to wait 10 months. It's 10/12. And when you multiply that out, you'll find that the interest, the discount that they're going to reduce, they're going to take $4,360 from us. $4,360. So that's their discount. $43.60. So that means that when we discount this note to the bank, we're going to walk out of the bank with $39,240. First, we had to figure out the full amount of maturity, then determine the bank's discount using the bank's discount rate, and that determines how much cash we're going to walk out with. So let's see the journal entry for this. We're going to, I'll do it right here, we're going to credit. Well, we'll start with the debit. We're going to debit cash. We're going to get cash. So we're going to debit cash, $39,240. Okay. We're going to credit interest receivable for $600, because remember, we carried this note for 2 months. So we had to recognize the interest before we could discount it. So we have to credit the interest receivable, and we're also getting rid of the note. So we're going to credit the note receivable for $40,000. So we gave up $40,600, we got $39,240. That's a loss, debit loss on sale of note, $1,360. The things that you had to remember was you had to remember to do this interest calculation before you sold the note. Then on June 30th, we sold merchandise to these folks for $20,000. The sale of the terms are 2% 10, and they used the gross method. So that simply means that they're going to debit accounts receivable and credit sales for 20 grand. Okay. Now, this company paid its account in full. So they didn't have to pay the full amount. They only had to pay 98% because they're taking their 2% discount. So 2% discount of 20,000 is 400. So what we had to do for these is we had to debit cash, $19,600, debit sales discount, $400, credit accounts receivable, all 20 grand. And the next one is they sold stock in a non-public company with a book value of $5,800 and accepted a $7,600 non-interest bearing note with a discount rate of 12%. So let's see, this is August 31st and it's due February 28th, so that's 6 months. So we need to figure out the discount. The value at maturity, $7,600 times 12% times 6/12, half a year. So 6% of $7,600 is $456. So we're going to debit note receivable, $7,600. We're going to credit, and all the rest of these are credits, credit the discount on the note, $456. We're going to credit investments, $5,800. That was our book value. And we got a gain on this, and the gain is the difference between 62.56 and 76. So credit gain on sale of investment, $1,344. And then at the end of the year, they tell us that bad debt expense is 3% of credit sales. So 3% of credit sales is, what do they tell us? The credit sales are $780,000. 780,123 times 0.03, 23,400. So that will be a debit to bad debt expense and a credit to allowance for doubtful accounts. Okay, so we thought through these. Now let me go through and I'll fill in the journal. I have it right here. The first account they told us was we wrote off $2,500 in bad debt. So let's use that $2,500. Debit allowance for doubtful accounts, $2,500. Credit accounts receivable, $2,500. Then we loaned that $40,000 to the officer. We're good on that. Now, normally we wouldn't have to do anything, but we're getting ready. At the end of May, we decide we're going to sell this note. We're going to discount this note. We're going to turn this note into a bank. We're going to get these people to give us money for this note. So we have to update our interest receivable and our interest revenue to determine the value of what we're getting rid of, what we're giving up, and take a look and see what we're getting all together. So we have interest receivable, and our interest receivable is $40,000 times 9%, because that was our terms with our employee, and this is for 2/12 or 1/6 of the year. And when you do that, you come up with $600. So we have to recognize interest receivable of $600 and interest revenue of $600. In other words, if this guy decided to pay us back right now, he would pay us back $40,600. Now, we have to figure out how much cash we're getting and the loss and all of that. We went through that again. Remember, that was this computation. So we have the 40,000 plus the 36 gives us the 43,600 to maturity. We have to figure out the discount using the bank's rate of 43.60. Hence, we're walking out of the bank with 39,240. So our cash, 39,240. Now we have to look at some of the other things. We gave up the note for 40,000. We gave up the interest receivable of 600. The difference between these two minus this is our loss on the sale of the note. And when you do that math, it comes up to, actually it's arithmetic, 1,360. Now on the 20th, we sold some stuff to this company for 20,000. And then very shortly afterwards, they paid. So we didn't get the 20,000. We got 19,600. They got a $400 discount, and we credited accounts receivable for that amount. Now we had the note receivable, and again, if we have to go back to the problem, what we gave up was $7,600. We had to figure out the discount, which was $7,600 times 12% times 6/12, $456. Our carrying value, our book value, was $5,800, and these two added together, subtracted from that, gives us our gain. Okay? And then our bad debt expense, they tell us 3% of credit sales. And we did 3% of 780,000 as they told us, and that gave us our amount, 23,400. 23,400. Good overall review, okay? And it says, are there any additional journal entries? Well, there is. We would record the amortization of the note at the end. Okay, so that would be the last thing we would do, is recognize that we have used up some of the note. So we would debit the discount and credit interest revenue.